For the past few years, NIO stock has been on a downward spiral, with only fleeting moments of reprieve. But are things genuinely looking up lately? Since hitting rock bottom in mid-April, NIO stock has rallied, climbing a staggering 42%. Yet, many experts remain cautious, questioning if this rise can be sustained. The company has made some moves that seem to please investors. They've expanded their reach and gained traction in the EV market. But is this enough to maintain momentum? The burning question remains: is now the right time to jump on the NIO bandwagon and invest in some NIO stocks? Let's take a closer look at NIO's recent moves and their stock performance. NIO's stock, mirroring the broader EV industry, has struggled this year, and several factors contribute to this decline. First, EV demand hasn't been as robust as expected. Second, significant concerns persist about whether there are enough charging stations and infrastructure to support a large number of EVs on the road. Back in early 2021, NIO's stock price soared to over $60 per share during a wave of excitement about electric vehicles. Investors were willing to pay a premium for companies in this industry, even if they weren't yet profitable. This enthusiasm drove NIO's stock price to unsustainable levels. Now, with the stock price down around $5 per share, some are pondering if it's a good time to buy in. But does the current price truly reflect the company's actual value? NIO has recently hit impressive milestones, delivering 20,544 vehicles in May, their best month ever. Analysts at Morgan Stanley foresaw this surge and remain optimistic, giving the stock a buy rating with a price target of $10 per share. For investors, this could mean substantial gains. Currently, NIO stock trades around $5.39, so Morgan Stanley's target suggests a potential increase of about 85%. But is this rise too good to be true? The stock market is notoriously unpredictable, and nothing is ever certain. NIO's success isn't limited to one type of vehicle. Both their SUVs and sedans saw healthy sales growth. SUV sales increased 38% month-over-month to reach 12,200 units, while sedan sales rose 30% to hit 8,400 units. But can NIO continue to hit the mark across the board, catering to diverse customer preferences in the electric vehicle market? Are these growth numbers sustainable, or just a temporary spike? While the sales figures are undeniably impressive, the focus is shifting towards profitability. Investors eagerly await news on NIO's profit margins and the company's guidance for the second quarter, which will be revealed during their upcoming earnings call. This information will be crucial for investors to gauge NIO's future prospects. But will the news be as positive as some hope? Morgan Stanley analyst Tim Xia reports that NIO has been receiving a lot of orders recently, around 6,000 per week in the first week of June. NIO will be announcing their earnings for the first quarter, January, through March of 2024. Investors are most interested in two things: whether NIO can maintain this high order volume and how much profit they're making on each car. Xia also notes that for the stock price to rise, investors need good news about future orders and profits, as well as updates about NIO's new sub-brand, Envo. But can NIO consistently deliver this good news? Investors are closely watching a key measure called vehicle margin, which indicates how much profit NIO makes on each car. In the last quarter, their vehicle margin was 11.9%, higher than the previous quarter and significantly higher than the year before. Management at NIO has set a goal of reaching a vehicle margin of 15 to 18% for the whole year. But can NIO meet these ambitious targets? There's more to the story than just profit on each car. NIO is still losing money overall due to high manufacturing costs and other operating expenses. In fact, their operating losses increased by 37% compared to the same quarter last year, although they decreased slightly compared to the previous quarter, Q3 2023. The key for NIO's future success is to keep improving their operating margin. This means not only making more money on each car they sell, but also finding ways to reduce their overall costs. But can NIO sustain this progress and move toward profitability? Have you ever had your personal information exposed in a data breach? It's unsettling, right? Data brokers sell our information to scammers every day. Your full name, email, home address, health records, and even relatives' details. That's why we use Aura, today's video sponsor. Aura identifies data brokers with our information and automatically submits opt-out requests, reducing spam and protecting us from hackers who could access our social media, bank accounts, or other sensitive info. Recently, AT&T revealed over 73 million customer records were released on the dark web. They recommend strong passwords, monitoring accounts, and considering credit freezes or fraud alerts. Aura handles all of this for us, so we don't need multiple apps to stay secure. If our data is compromised, we don't worry because Aura is always on and protecting us. We value our privacy and yours. Visit aura.com/ultiumtech to start your 14-day trial of Aura, also linked in the description below. Are there enough growth drivers for NIO? China leads the world in electric vehicle adoption, with the government actively promoting clean energy and reducing reliance on fossil fuels. This creates a strong tailwind for NIO, even if EV demand slows down globally. Additionally, NIO seems favored by the Chinese government, which could give them an edge over competitors. But will this government support last? The company also has a diverse and growing product lineup. NIO offers various electric vehicle models, including SUVs and sedans, catering to different customer needs and preferences. This broad portfolio helps them capture a larger share of the market. Their recent record deliveries of over 20,000 vehicles in a month suggest increasing customer interest. So far in 2024, they've delivered over 66,000 vehicles, a significant year-over-year jump. But will they maintain this growth? NIO's unique battery swap technology allows drivers to quickly exchange depleted batteries for fully charged ones, addressing a major concern for EV owners: range anxiety. This battery-as-a-service strategy could be a major selling point for customers who value convenience and faster charging times. Their extensive network of charging stations, over 2,400 globally, and plans for further expansion in 2024 show their commitment to this technology. Partnering with other Chinese automakers strengthens this ecosystem, making it more attractive to potential customers. But will this strategy pay off in the long run? NIO's financial position has improved thanks to a $2.2 billion investment from Abu Dhabi's CVN Holdings. This cash infusion has strengthened NIO's balance sheet, allowing them to boost their brand, improve sales and service, and make serious investments in their core technologies. But can they continue to attract such significant investments in the future? Then there's the new Envo model, the L60, priced at around 250,000 renminbi, $34,636. It aims to reduce production costs, making them more efficient and competitive. But will this model truly resonate with consumers? Should you buy NIO stock now? NIO presents a compelling case for investors interested in the booming Chinese electric vehicle market. The recent acquisition from Abu Dhabi and strategic moves like the Envo model and production plant acquisition position them to capitalize on this growth. However, significant risks cloud this optimistic outlook. NIO remains unprofitable, requiring continuous capital injections. This constant need for funding raises the specter of dilution, where existing shareholders' ownership stakes get watered down if the company issues new shares. Furthermore, any positive stock movement could be quickly offset by the need to raise more capital through share issuance. Fierce competition in the Chinese EV market is another major concern. New players and models constantly emerge, forcing established companies like NIO to slash prices to attract buyers. This price war could squeeze their profit margins further, jeopardizing their path to profitability. Discouragingly, analyst expectations for losses per share are widening, indicating potential continued financial struggles in the near future. Finally, the stock's valuation needs careful consideration. While NIO's price-to-sales ratio is lower than its historically inflated highs, it's still above the industry average. This suggests that the stock might not be a bargain at its current price point. The decision to invest in NIO hinges on your risk tolerance and investment horizon. The company boasts strong growth potential in a promising market and is taking strategic steps to solidify its position. However, the lack of profitability, intense competition, and ongoing losses pose significant challenges. If you're a long-term investor who believes in the future of electric vehicles and NIO's ability to overcome these hurdles, then the stock might be worth considering. But for those seeking a safer investment with quicker potential returns, NIO might not be the best fit. It's crucial to conduct your own research and weigh all the factors before making any investment decisions. In essence, NIO is on a roll. However, the big question remains: can they maintain this momentum and translate their sales success into a sustainable and profitable business model? The upcoming earnings call will be a significant event, providing valuable insights into NIO's ability to navigate the competitive electric vehicle landscape. What do you think about this? Let us know in the comments section.